Hello. Welcome, everybody. We are here for end of year tax tips. My name is Francisco Sirvent. I know a lot of you attending. I don't know everybody. Welcome. Like I said, my name is Francisco Sirvent. I'm the founder and one of the attorneys here at Keystone Law Firm, along with, I think, my partner, Michelle Dexter's here, and Alexis is also on, one of our other team members. So thank you, everybody, for coming. Before I dive into the topic, I do want to just give you guys a couple housekeeping ideas. First, we are recording this so that we can share it out afterwards onto our YouTube channel. If you haven't been over there, check it out. We are putting all of our webinars up there so you can watch it with us live. If you missed any of the past ones, you can go back there and catch them. They are presented in full. And if we talk about something here that sparked your interest and you just need to listen to it again because you know, just sometimes you need to hear it once or twice, you can pause, you can slow it down, you can speed it up, whatever you want. It'll be there for you. As well as if you know somebody who would like to learn this stuff, you're welcome to point them to that YouTube channel. It's pretty easy to find. It's youtube.com/Keystone Law Firm. Pretty easy to find. Also have a bunch of other good videos there about what we do with estate planning, trusts, wills, probate, things like that. So hopefully there's some stuff in there that'll give you some tips and answers to help you take care of your family. We also have some of our 2026 webinars scheduled. So check back to our events page on our website, keystonelawfirm.com/events, and you'll be able to see what's coming. Excited to have those. I think this is our last one for the year. So congratulations to those of you who made it. Good job. We're here. Let's get started. A lot has changed this year in the tax code. And it's funny, actually, a lot has changed, but a lot of it remains the same. So we're going to go through these. I am happy to take questions as we go, though I am not going to unmute your microphone. Just drop your question in the chat feature. Best way for me to manage that. When we get to the end, we'll have time for questions on a live basis, and I'll let you turn your microphone on if you want to. But because we are recording this, please don't say anything too personally identifiable. Don't say too much about your situation because it's going to be shared publicly. Just ask your questions in a way that feel generic enough or hypothetical enough that it doesn't bother you to share widely. So, yes, the lovely legal notices. This is general information of an educational nature. This is not specific legal, tax, or financial advice for your situation. So, if you need specific legal, tax, or financial information, please get that from your qualified advisor. If you don't have somebody who helps you take care of all those things under one roof, that's what we do with our retirement management office. I'd be happy to speak with anybody about that if you don't have those services combined under one roof. All right, so quick hitters for this year. Every year, if you're in retirement and you're past the age of RMD, your required minimum distributions from your retirement accounts, those IRAs, 401ks, things like that, please make sure it's done. There are big penalties if you don't take it in the year that it's due. Even if you don't need it, you must take it. So double check your numbers. It is required by anybody you have an IRA with. It's required by the institution at the end of last year on your December statement from December, or sorry, on your January statement, it should say your December 31st balance was this, which means you have to take out this much during 2025. So go back to each of your accounts, review those numbers, and confirm. You don't have to take the individual amount from each account. If you have multiples, you can take it all from one, but the aggregate has to be at least that much. So this is, we're on December 17th. Most institutions can still get those distributions done, but if you call them on the 31st, they are probably not going to be able to get it satisfied. So put your head down, calculate your numbers, and figure that out if you haven't done that already. There are still some people who can make contributions into their IRAs and Roth accounts. Those are not due until tax day next year, but there's no reason why you can't look at that and figure that out and make those happen this year and get that money in there. And you can make contributions if you have earned income, okay? So if you're still doing a little consulting on the side, you have some part-time gig or something where you're getting, actual earned income, like on a 1099 even or something, or a W-2, you can make contributions. And if you make contributions to an IRA, that's going to reduce your taxable income. If you make contributions to a Roth, it does not. But I think it's a good time to look at that and think if you should. But also, if you are employed and your employer has 401k or 403 plans in place, you have to make those before the end of the year. It's a good time to make catch-ups on that. You can tell your employer, hopefully there's still time for them to make adjustments on that account if you want to stuff some extra money into there before the end of the year. A lot of employers do match some percentage, but that doesn't limit you on how much you can put in. It just doesn't match it from your employer. At least do the match. But also you can put more money in there, which is a good savings tool, and it also reduces your income for the year. So take a look at those. It's also a good time to look at any brokerage accounts you have. So these are after-tax brokerage accounts, or if you have individual stock holdings. A lot of people hold Bitcoin, and Bitcoin's had a big dive the last couple of weeks. It might be a good time to harvest some of those losses. And just, I know it feels like taking a hit, but guess what? You can sell it now to take the loss. And as long as you wait at least 30 days to rebuy it, then you're not going to run in trouble with the wash sale rules. So you can take a loss right now, wait 30 days, rebuy it. It's probably going to be somewhere close. And you get a loss this year. And that'll go right on your taxes. So take advantage of some tax loss harvesting right now. You got to do those transactions before the end of the year. Also, Roth conversions. Quick idea. Some of you are in a tax bracket that has some room before you get to the next bracket. If you've got another $10,000 before you hit the next bracket, maybe you go ahead and convert that 10,000, because that conversion amount is going to add to your taxable income. But I think most people think taxes are going to go up in the future. And so if you can get some money out of the IRA into a Roth at these current tax rates, might not be a bad idea, even if you pay the tax now on it. So consider doing that. If you haven't done all your RMDs and you don't need the money, and you're already giving money to charity out of your checking account or something, stop doing that. Make those distributions, make those charitable gifts directly from your IRA. Okay, your advisor, whoever's holding your IRA should be able to help you do that. It's called a qualified charitable distribution, QCD for short. QCDs are a great way to use your RMD. The RMD is the IRS saying you must take money out of this account, but some clients don't need that money. And so they're just kind of taking the tax hit every time it comes. But instead of taking it out of the IRA and paying taxes on it, you could just direct it from your IRA to the charity directly, and then it never counts as income to you. So it basically reduces your income. It's a great tool. So look at doing QCDs. Again, we're close to the end of the year. They should still be able to process those in time. Don't wait much longer. That's like a today, tomorrow task to get that going. Arizona tax credits. Arizona has a great tax credit program, and it benefits public schools, private schools. There's some that benefit the poor. Those are phenomenal. So if you have any state income tax liability, you can offset, I think it's up to $2,000 or $3,000 of that by making a charitable gift to one of these organizations. They have to be on the list of one of the qualifying organizations, and you can get that from Arizona's Department of Revenue. You just make a gift of $1,000 to charity, basically, to the school, to this private school, to one of these organizations. And then when you go file your tax return next year, you use this gift to actually get a refund of your Arizona state taxes dollar for dollar. This is one of the best things in the world. Best things in the world. You get to basically say, instead of paying my Arizona state income tax bill, which is $823, I gave $823 to this organization. State of Arizona, give me that money back. And it's a full refund. It's amazing. Now, if you give more than you have in state taxes, you don't get more back. You get just the amount of your taxes. It's a great way to benefit charities or schools that are important to you personally. All right. Now, some things that you don't need to do anything about right now, but to think about when you file your return next year. Either maybe you have a child, maybe you know somebody that this applies to, are some new things. And this is the bonus senior deduction. So if you're 65 or older, it's $6,000 a single person, $12,000 married couples, you get extra deduction. You don't need to do anything now about that because you know it's coming, but you may think about that now because you get that extra deduction on your income. Maybe that gives you room to do a Roth conversion or something else, right? Trigger some more income this year because you get an extra deduction on your tax return. You could literally save, if you're in a 20% tax bracket, 20% of 6,000 is $1,200 in taxes that you don't pay. Or $12,000, it's $2,400 in taxes you don't pay. So you might actually play that game of intentionally increasing your income because you get that extra deduction. They also, the big bill also passed a law saying $25,000 of qualified tip income is now going to not be taxed. So great, you all can send tips into my employees at Keystone Law Firm now, and they won't pay taxes on it. Ha ha ha. Also, qualified overtime income has new exemptions of $12,500 or $25,000 for married couples, and then $10,000 of qualified vehicle loan interest. So if you have loans on cars and it meets all the criteria, the interest on that is now going to be a deduction. Great. So there's some quick hitters. The charitable giving changes, still a little bit confusing to me. I'm trying to organize it in my head, and this is the best I can do. A lot of us give money to charity, to our church, to organizations that are struggling. We gave money to some hurricane organizations this year that were helping out in Jamaica because we vacation there, and we thought that'd be a good thing to do. It's broken down in this, I think, in this way. For those who do not itemize, okay, if you take the standard deduction, that's you. You don't itemize your deductions, okay? So if you don't itemize, you actually can now take an additional deduction of up to $1,000 for single, $2,000 for married couples for charitable gifts. Okay, if you don't itemize. This wasn't available in prior years. So this is an incentive to give to charity. So you might have given $6,000 to charity this year. If you don't itemize and you're a single person, you only get to deduct an extra $1,000. Okay, so that's for those who don't itemize. If you do itemize, because your deductions are more than the standard deduction, that's you itemize your deductions, then the rule now says your gift to charity is reduced by 0.5% of your adjusted gross income. Okay, so in the example, if a couple that does itemize, say they gave $5,000 to charity in that year, okay, charitable deduction is going to be one of their itemized deductions, but it's reduced by 0.5% of their adjusted gross income. Okay, so it gets this little reduction on it. You still include it in your itemized deductions, but it's reduced by that 0.5% of your AGI. I think that's the best way I can understand it. This year, gifting. If you want to do gifting, this can be done strategically as part of your estate plan and a tax planning strategy, or just because you're gifting to your family. This year, the gift limits are $19,000 per person that's receiving the gift and per person that's giving the gift, and that's per year. So if it's just me and I'm giving to one person, I give them $19,000, and there's no gift tax consequence to either of us, okay? If it's me and my wife, and we want to make a gift to one person, I can give 19,000, she can give 19,000, and there's no gift tax consequences in that scenario. But if it's me, my wife, and our 4 kids, we can give 19, 19, 19, 19, and 19, 19, 19, 19. Okay, so you can give away a lot of money if you're married and you have a lot of people you want to give gifts to. Now, strategically, if you want that to be part of your estate plan because you're concerned about estate taxes, giving cash is the least favorable way to take advantage of those strategies. It's not a bad way, it's better than doing nothing, but there are better ways to strategically package that. It's too late in this year to take advantage of those better strategies, but at least if you want to do gifting, get those done before the end of this year. IRMA, if you are on Medicare or you are potentially going to be on Medicare in the near future, you need to start learning about IRMA. This is the penalty premium that gets assessed against you if your modified adjusted gross income exceeds certain limits. So if your modified adjusted gross income is below those limits, you have no extra IRMA penalty assessed. But if you do, then you're paying more for Medicare than everybody else. The limit for this year is $106,000 for an individual person and $212,000 for a married couple. Right now is the time to figure out what your modified adjusted gross income is. Get your best guess, dial that in, and see if you're going to be above that, because it can be triggered by the sale of stock. It can be triggered by the sale of a rental property. It can be triggered by a lot of things. Cashing out an IRA, doing a Roth conversion, pulling out money from an IRA. It can be triggered by a lot of things. So look at that now, and then if you are over those limits, see what you can do to pull in more deductions to maybe get you back down below that limit. Okay, because if that hits you, the penalty premium isn't just for 1 year, it goes for multiple years. So this is the time to check that number. I mean, the best time would be to do it 3 months ago, but it's not too late. All right, for my business owner clients, we could spend a whole half day on business owner tax strategies, but just some quick reminders for business tax strategies. Oh, Gene, let me get your question real quick. If you give to more than one person, what is the limit for the giver? So as the giver, let me bounce back to that real quick. On gifting, it's per recipient and per donee, okay? So, or per giver and per givee, whatever they're called, right? So that means if I, Francisco, wanted to give $19,000 and I had the money to do it to 1 million people out there, give them each $19,000, I'm allowed to. I'd be giving away $19 billion, right? But I'm within this limit. There's no gift tax consequence to me or to them. There's no income tax because gifts are not income. So you can give away $19,000 to as many people as you want. Doesn't matter. They can be adults or children. They can be minors. You can give away $19,000 to as many people as you want. There's no limit on how many recipients there are. From one person to as many people as you want. Let me know if that answered your question, or if not, pop it back into the chat. So for business owners, the biggest one that came through with the new act was the 100% bonus depreciation, the extension of this. And this is just a huge tax strategy for mostly small business owners that are going to get the benefit out of this one. This just means that instead of buying a large piece of equipment, there's a whole ton of things that businesses spend big chunks of capital on, and the default rules are that you have to deduct it over time. Since it's going to last many, many years, the tax code says you can only deduct a small portion of it every year, even if you paid cash for it all up front. That's changed now. You can take the depreciation all in the year that you put the thing into service. So the thing that if you buy it and put it in service this year, you get all that bonus depreciation right now. So you actually get the deduction when the money goes out the door. Huge benefit. There are even investment strategies that are connected to that you can invest money in something and get a big deduction for your investment. Section 179 accelerated expensing is also a huge advantage for business owners. So again, instead of depreciating a vehicle purchase for the business, or all of your office furniture, equipment, things like that, you just expense it out in the first year that you put it in service. Two other things that are always on my mind for business owners is if you're looking at your current year to date, you're looking at your P&L and you're showing more net income than you want to already, just try to defer some of the revenue into next year, right? If you're on a cash basis accrual system, just defer the revenue. Don't, tell your clients, pay me on January 1st. Tell your customers, pay this invoice on January 1st. And just defer it to next year. Make it next year's problem. Deferral, deferral, deferral. And on the flip side, go ahead and look at January's bills that you know you're going to have to pay. Figure out, should I just pay some of them now in December? So I can pay some of those now, and I'm on cash basis, I get to expense those and deduct those this year. So you sort of squeeze it from both ends. And then for businesses that have 401k or SEP IRAs in place as a retirement benefit, the business makes contributions to those plans in addition to the employees contributing. The business makes contributions to those. The business's contributions to those are a deduction to the business. So go ahead and stuff all those contributions in there this year. Don't wait to do that next year. Just fill those contributions up, get those retirement plans completely funded or fully funded, and take those deductions this year. And then a bunch of things for rental property owners. This is definitely not a comprehensive list, but if you own even just one rental property, a whole lot of things to consider. Are you documenting your expenses between repairs versus improvements? Okay, repairs are expensed and deducted this year. Improvements have to be depreciated. So a new roof, new AC, other big capital improvements, those have to be depreciated. So make sure you're categorizing those correctly. Obviously, don't put in the improvements category things that should be in the repairs category, because you want those deductions this year. If you can document that you are an active participant, you get a little bit better ability to take your net losses on your rental activities and use those losses to offset other income. So active participation has very strict rules, but if you can document that you are an active participant in this rental business and that business shows a loss for the year, a lot of times real estate does show a loss, even if you're actively renting it because of the depreciation you're taking on the house. So a lot of times you show a loss. Well, it just kind of sits there and sits there and sits there a lot of times. But if you can show you're an active participant in the rental business, then you have the ability to take that loss and offset some of your other income, which is even better. And that's where you get real leverage on your rental activities. The other thing is to think about, if you can't document that you're an active participant, okay, if you can't do that, okay, then your rental activities are passive. Well, where else in your life do you have passive losses that you can offset, right? Or I'm sorry, passive gain, either passive losses or gains, right? If you have a loss on your rental business, where do you have passive gains? Maybe you can go ahead and trigger some of those gains. They net out, okay? They net out. So short term, long term, then you get those and then they net. So where can you use the losses from one to offset the gains from another, or the gains from rentals to offset losses from another? It's one of the hard things about passive losses is they just carry forward until you have enough passive gains to use them. And it's like, we want to use these deductions. We want to use these losses in the current year as much as possible. So find other places you have passive activities that have the other version. If you have gains on this side, look for losses. If you have losses on this side, look for gains and intentionally trigger them so that they net out. Even with one rental property, you have expenses, you have things you need to do. Well, can you pay family members to do those? Because those will be deductions to your rental business. And maybe those family members happen to be your kids who are in a much, much lower tax bracket and are going to take that income in maybe a 0% tax bracket. I don't know, maybe. That's just an idea. Start thinking about doing a cost segregation study. If you haven't looked into that strategy, it's really a time tested. It's been around for a long time. And it's the recognition that the whole piece of real estate, everybody generally depreciates them on the standard schedule for 27 and a half years. Well, the IRS rules allow you to say, look, it's not like the whole thing lasts 27 and a half years and then it's gone and I got to replace the whole house. No, there are components of the house that have to be replaced as you go. Water heaters, cabinets sometimes, air conditioning, all kinds of things. Those components of it, if you do a cost segregation study, itemizes those components and says what they are and under what schedule you can depreciate them. And a lot of times it's depreciation in the first year, as soon as you do the study. So you may be able to get a very big deduction all in 1 year just by doing a cost segregation study. So think about doing that for next year. That big deduction can help you if you're planning to sell another piece of real estate that has some gains or some other income generating activity. You're like, I need some other deductions. That's something to really think about. Rental property owners deduct or expense everything. Mileage, actual vehicle expenses, home office if you are managing the property, bookkeeping, CPA, legal fees, property management software, phone, internet, HOA fees, licenses, permits, insurance renewals. Just find everything you can and make sure you're expensing it. All of those things directly offset the rental income that you receive, and that reduces your taxes. All right. That doesn't need to be more painful than it is. Those are your 2025 end of year tax tips. Anybody have any questions, ideas, thoughts, something I missed that you maybe thought of? I will also give you guys a plug for our first webinar for next year. On January 2nd, Michelle is going to be teaching that webinar. And this one is called, Do You Think You're Too Rich for Medicaid Nursing Home Benefits? So if you would like to sign up, I'm going to drop the date, Jan 2, 2026 webinar sign up. So if you think you're too rich for Medicaid or Medicaid nursing home benefits, join that one. She's going to share with you some ideas. I see a hand up. Let me change our system real quick. All right, I think if you have a question, you can unmute yourself. Sue asked a question in the chat. Can you touch on what are more desirable ways to do gifting other than cash? There's a lot of ways to do it. They get complex, but here's an example. Giving away $10,000 of cash or $19,000 of cash uses up your entire annual exclusion amount. You can't give more cash. You'll be subject to gift tax. Well, what if you had $19,000? I'm not saying do this, okay, but let me set up the scenario. What if you had $19,000 worth of stock? Okay, you got exactly $19,000 worth of stock, and you gift the stock. Well, perfect. You've now gifted your stock. It's not the best way to do it, but hold that in your mind for a minute. $19,000 worth of stock. You give the stock, you use up your annual exclusion for that person. What you can do for folks who have an estate that justifies this is you can take your brokerage account of your stock portfolio or some portion of it and move it into a new type of an account and then gift portions of that account away that equal $19,000 in value. And by doing that, those portions that are gifted, you can set rules around it. You can't cash it in, you can't spend it, you can't change the investments, and you pretty much don't even get access to it, but it's now out of your estate. So that's one way to do it. It's somewhat of a unique structure. It's done through a family limited partnership, but you stay in control, you decide how things are invested, and but you get to start reducing the size of your estate. So that's one of the simplest strategies to explain how that works. What's even more neat about that is depending on how you want to structure that, you could just give straight $19,000 worth of that account in shares or in sort of ownership rights, but it's a gift of straight value. But if you do the second step, you can actually do a discounting appraisal, which says gifting that little share of this account actually isn't worth 19,000 because they really don't have as much control as if you gave them a check for 19,000. So giving them 19,000 is actually only worth like 10,000 or 12,000. So you can actually give more than 19 and actually get out of your estate more than 19,000 per person per year and still be within that $19,000 limit. Rather complex, but use a discounting and a limited partnership structure to do that. Anybody else have, Alexis is correcting me. Her webinar is on January 14th. Sorry for goofing the date. Thank you for correcting me, Alexis. I see that now. I was looking at the wrong thing. January 14th at 4 p.m. Click that link to join. Also, if anybody heard something we talked about today or anything else that we've talked about in the past and you guys want to sit down and chat with me or first just jump on a quick call, feel free to schedule with me. I'll drop my link in the chat right here. Jen asked, Gene, I'm reading correctly. Gene, can you also just pay for some expenses and not count for gift limit? No, if they are expenses of somebody else, they're going to count towards the gift limit. They are not your expenses, so it's a gift under IRS rules, and it's just going to fall within that $19,000 limit. So there's, no way around that. If it's their expense, it's their expense, and you're making a gift. Good questions, good thoughts. Anybody else have anything you're curious about? And I'll drop one more link into the chat, which I encourage you guys all to go look at. Oops, let me grab it real quick. And actually, I'll ask everybody a favor. If you would, I just put the link to our Keystone YouTube channel. We're trying to do a little bit better on that channel just to get more information out there. That's why we've been doing this all this year. If you would you click on that, let it open up on your screen, and just hit the subscribe button. That helps the algorithm do its magic and puts it in front of more people. Just the more subscribers we get, obviously. And it doesn't I don't think it really like annoys you with anything by subscribing to it, other than when you open YouTube, it might say there's Keystone that you subscribe to. And when we post a video, I think YouTube might send you an email, which hopefully isn't a bad thing for you. But if you would, that'd be great help for us just to get a couple more subscribers to help YouTube know we are a useful source of information. All right, it looks like we are all out of questions. I won't keep everybody here just for fun and purposes. Everybody have a wonderful end of the year. Merry Christmas, Happy Hanukkah, Happy Holidays. We will see you back in January if we don't see you before then. Everybody have a wonderful holiday. Thanks for being here.